You've been told to save into your 401k your entire career. Pre-tax contributions, tax-deferred growth. Seems like a no-brainer, right? But no one ever told you about the tax trap of 401ks and IRAs, and it could end up costing you tens, if not hundreds of thousands of dollars in unexpected taxes during retirement. This is especially important if you're around the age of 60 and you've done the hard part. You've saved maybe $1 million, $2 million for retirement, but it's mostly sitting in pre-tax, tax-deferred vehicles like IRAs or 401ks. But if you don't manage those account balances properly from a tax perspective, it becomes a tax tsunami that you cannot contain. And not only will it impact those withdrawals and those account balances, but taxes on your Social Security income, or even excess premiums for Medicare costs, or even taxes to your heirs. So I'm bringing this up because I've personally seen it in my own financial planning practice for over a decade now. Many of the folks we serve are smart, successful people just like yourself. We recently had a client run the numbers with them as well. The light bulb went off and he looked at me and said, "Kevin, why didn't anyone tell me this sooner?" And honestly, that's exactly why I'm making this video. Because if you can understand this now in your early 60s, you still have time to do something about it. So stick with me because I'm going to show you exactly what the 401k tax trap is, and then I'll share 4 practical strategies to help you avoid overpaying the IRS in retirement. So before we jump in really quickly, I actually thought personally I'd coined the term from the PFR podcast, episode number 2, way back in the day, the 401k tax trap. But it turns out I'm not that creative. There are a bunch of other videos out there on the internet with a similar title and a similar concept here. But many of the videos I've noticed are essentially pitches to tell you to stop your 401k and start some sort of life insurance policy, whether it be an IUL or some sort of whole life policy. I'm just here to tell you, spoiler alert, this is not that. I am pro 401k, I am pro IRA, but I'm also pro managing the timing of both those contributions and distributions in order to help you minimize your lifetime tax bill. So most of the folks we serve in our financial planning practice enter retirement with mostly pre-tax 401k or IRA dollars. And that makes a lot of sense. Roth accounts did not really become mainstream up until the last decade or so. So if you're in that situation, you are not alone. And many of you are now in your peak earning years, so you'll likely want to continue because those pre-tax 401ks allow you for contributions to reduce your taxable income in the year you make those contributions. And then those contributions will grow. Hopefully they're invested properly and they'll grow tax deferred. But the key is you've never paid taxes on that money yet, not only on your contributions, but also on the growth in earnings within that account, unless, of course, those accounts are in Roth balances. And most of our clients have a distribution that looks something like this, what I have on my screen here. So we like to run these tax allocation summaries for all of our clients. It breaks down their balance sheet with just their investable assets, and it shows them visually what the distribution is between taxable accounts, tax-deferred accounts, and tax-free accounts. And most of the clients that we serve have the majority, if not all, of their funds in this number 2, this tax-deferred bucket. In this case, this represents approximately 92% of the total investment portfolio balance. And then the taxable side, bucket number 1, represents about 8%. Now, obviously, this couple, they've done really, really well saving and investing to get to this point where they are in their early 60s and they're hoping to transition to retirement next year. And they come to us and say, "Hey, Kevin, what should we do from a distribution perspective? Here's our balance sheet. Now we run the tax allocation summary, and then we project out what their lifetime goals are and ultimately the impact from a cash flow standpoint and from a tax standpoint." What happens when you retire, and for a lot of folks that come to us maybe later in their 60s, maybe they've been retired for a few years, what we like to call the honeymoon phase of taxes in retirement. Because as you can see with this couple at 62, this is this year, this is their final year of working. They're in this 12% tax bracket. So they're not super high income, but they've sacrificed, they've scrapped, they've saved, and they've gotten to this point where they can become work optional next year when they turn 63. And then once they turn 63, now they're in this honeymoon phase where all of a sudden their tax bracket drops, as you can see. And so the reason is because they have no Social Security yet. They have no pensions. They're not even starting to withdraw from IRAs fully yet. They have that taxable account, that taxable brokerage account, and they'll be using that for income during this bridge period. But sometimes what we see retirees is that they don't even have enough income to show to exceed the standard deduction. Okay, despite having 7 figures or multiple 7 figures saved for retirement. So I see retirees oftentimes, they get very complacent in this honeymoon phase. They almost feel like they're kind of winning, they're gaming the system. They're sort of like winning against the IRS. They've deferred their taxes, they got that tax deduction, and now they enter retirement in this honeymoon phase up until Social Security kicks in. But even then, it only bumps them up into the 12% bracket here. Okay, so which is the same as they were pre-retirement, and they stay there for quite a while. So again, this honeymoon phase, I oftentimes see retirees that get stuck here. They get complacent. They're enjoying these years of very, very low taxes, and they're riding off into the sunset thinking, hey, you know what? We've won the game. Well, what happens is then the RMD phase kicks in. RMD stands for Required Minimum Distributions. Okay, so for most of you, they will begin either at age 73 or at age 75. And that is the first year in which the IRS, they essentially force you to start making withdrawals from these tax-deferred IRAs, tax-deferred 401ks, TSBs, 403bs, 457bs, you name it. Any qualified plan that's tax-deferred now has an RMD, even if you don't need the income from that RMD. Okay, the government wants their cut, and they're going to be taxing those RMDs, those required minimum distributions, as ordinary income. And a couple with about $2 million saved in a 401k or IRA, they could be forced to withdraw upwards of about $70,000 that first year during that RMD phase. And it only goes up from there because of the fact that it's linked to your life expectancy. And that income, that $70,000 or whatever that number is for you that first year, once you take that RMD, now you combine that with Social Security, because that's begun. In this example, they started Social Security at 67, maybe pension income, if that's applicable. Maybe you also have capital gains or dividend income from a brokerage account. Maybe you also have some interest income, or maybe even rental income. So as you can see, that income can really add up very, very quickly. And all of a sudden, you hit that magic RMD age. Now the honeymoon is over. Okay, the party is over. Now you're going to have to start making withdrawals from those tax-deferred accounts. So as you can see in this illustration, I've now looked past age 73, okay, which is when they're going to be starting to take required minimum distributions. What you'll notice is they had the honeymoon phase last pretty long, okay, for over 10 years or about 10 years, and then the honeymoon phase is over. RMDs begin. Required minimum distributions begin, and now all of a sudden their tax bracket jumps to the 22% level, and it actually stays there for a while, and then at 82, 83, it goes up again to the 24% level. This is what we're talking about with the tax trap of 401ks. This catches people off guard all the time. Most people assume, you know what? Lower taxes in retirement, lower tax brackets in retirement, which could be true for a period of time. But if you have a sizable tax deferred account, an IRA or 401k, most people don't account for that account size to continue to grow, continue to compound in retirement. And then they hit those RMDs, and all of a sudden their RMDs push them into the next tax bracket, or even 2 tax brackets above what they were used to at the beginning phase of retirement. This is that tax trap that we were talking about. Most folks, they miss out on those opportunities. They miss those years of the honeymoon phase, all of those years of very low tax brackets where they could have looked at other strategies to minimize the impact of those RMDs once they turn 73 or 75. This is why I did a video. Don't miss your Roth conversion window, which I will link after this one. So make sure to check that one out, because I go in detail in terms of when you should begin looking at Roth conversions. So we know what the tax trap is, and we understand that, 401ks can be a great tool, but how can we mitigate, or how can we avoid this tax trap of 401ks or traditional IRAs? Well, I have 4 strategies for you that you can look to take advantage of. Depends on what life stage you're in, but the first one I would highly recommend and encourage you to look at is taking advantage of what I just talked about, which is that Roth conversion window. Again, I'm going to link the video at the end of this one, but essentially the Roth conversion window is when you want to start getting aggressive with those Roth conversions if that strategy aligns with your long-term plans. It is not going to be for everybody, okay? I think Roth conversions have become so mainstream that I think pre-retirees and retirees alike, they think that Roth conversions are a good strategy for everybody. This is not the case. But if it fits within the context of your long-term plan, it mathematically makes sense to do so. Make sure you take advantage of those Roth conversions during that Roth conversion window. The second thing I'd recommend you look at is potentially looking at withdrawals from those tax-deferred IRAs, tax-deferred 401ks strategically before you hit that RMD age, before you're in that tax trap and you're now in that 22 or 24% bracket as we looked at in this example, okay? The order of operation, the traditional order of operation from a spending perspective is traditionally taxable accounts first, then tax-deferred, then tax-free. That is not always the case, okay? Sometimes it makes sense to spend your tax-free first and then delay your tax-deferred. Sometimes it makes sense to do a combination of taxable and tax-deferred up front. Sometimes it makes sense to do a majority of those distributions in the tax-deferred accounts. But you can use those distributions before you hit RMD age to manage your cash flow needs and also manage your tax brackets both pre and post RMDs. The third strategy I'll throw out there is QCDs, or qualified charitable distributions. So starting at the age of 70 and a half, you are able to take a QCD or take advantage of this QCD strategy. Typically, when you're making a withdrawal from an IRA or 401k, it's going to be taxed as ordinary income, okay? Makes a lot of sense. But once you turn 70 and a half, you can donate up to $108,000 per year directly from your IRA. And the best part is, if you're also taking RMDs already, maybe you're 73, maybe you're 75, whatever your age might be, if you're already taking RMDs, that qualified charitable distribution can be used to reduce your RMD dollar for dollar. So while you probably shouldn't donate to charity just to reduce your taxes, if you are charitably inclined and you're over 70 and a half, this is one of my favorite strategies for my clients to use to satisfy their charitable giving, but also make it tax efficient for them as well. And then number 4, if you still have years to go in the accumulation phase, tax diversification is key. Making sure you fill up different buckets. Don't just go all in on one. Focus on filling up the taxable buckets, the tax deferred buckets, and tax-free buckets. I'm not saying go equal, because sometimes it makes sense to maybe go more aggressive into one depending on what your tax bracket looks each given year, okay? But if you can create some tax diversification, it gives you more options in that early phase of retirement, pre-RMD phase, in that Roth conversion window, and then could also help you optimize and minimize your lifetime tax bill as well. So in summary, your 401k is a great tool, but if you don't plan around the tax trap, it could become a tax bomb. But don't just watch this video and do nothing. Go consult with your financial planner. Go consult with your tax planner. If you want to learn more about working with our firm, this is what we do. We specialize in retirement planning exclusively, but more importantly, we also are tax strategy focused. We talk about things like Roth conversions, among other tax optimization strategies in retirement. So if you're interested in learning more about working with us, you can simply click on the retirement readiness questionnaire that's linked in the video, or you can visit our website at www.imaginefinancialsecurity.com. Thank you for watching, and make sure to hit the like button if you enjoyed the video, and of course subscribe to our channel so we can see each other again next week.